How's it going, everyone? Welcome to another episode of The Sweep. We're going to get started here in just a couple seconds. All right, welcome. And as always, like, share, and follow on social media, facebook.com/DayTradeSmart, Instagram, DayTradeSmart and the number 1, youtube.com, of course, where you guys are now, /The Proving Ground. And if you have questions beyond that, of course, feel free to email us at info@daytradesmart.com. All right, so what we're going to cover today is we're going to talk about psychology, right? The psychology of day trading. This is a big one, primarily because there's a lot of people that get, destroyed by some of the psychological facets of day trading. And so, obviously, in order to prepare for them, you need to know what they are, right? So when I was a kid, used to watch a lot of G.I. Joe, right? So knowing is half the battle. So one of the most, if not the most damaging effects to a pro day trader will face is the psychological facets of day trading. So you don't have to fall victim to their effects. On the contrary, there are a number of ways a day trader can create safeguards to prevent this from happening. The first line of defense is simply knowing what they are and acknowledging your proclivity to them. And you'll notice that some of these things are perhaps things that you may already deal with in other facets of life, and they can show their ugly face day trading. And if you've never traded a live account, and I won't say exclusively, because there are people that trade demo accounts just as seriously as they would trade a live account, and which is obviously the best way to practice, right? You practice like you play. But there are those that, and even those that treat a demo account like a live account still run into those psychological facets when transitioning to live money. Now, if you've been trading with live money for a while, or just getting started or whatever the case may be, you may find that some of these things don't pertain to you anymore. Perhaps you're callous to them now. Maybe you've created the callous in other facets of your life, and now it's not going to bother you while going into day trading. But I've never met anyone that hasn't had some kind of run-in with a psychological barrier while day trading live money in the market at some point. And it's different for everyone, right? There are people that have really high win percentages, and I've got traders that traded 90+% win percentages. And their struggle sometimes is the losers, right? If they have 2 back-to-back losers, which is common for anything below 70% or below 90%, right? If you're at 80% or 70%, 2 back-to-back losers is something that is going to happen often. When you have a high win percentage and you get, losers, or you're on a streak where you've had nothing but winners, you're on a hot streak. We've also had traders that have gone on months without having losers, right? And eventually you'll hit a loser, of course. But in that process, when they do finally hit that loser, some of them go on tilt, and they get in their head psychologically, and it affects them more than it should, right? And so being aware of some of these things and having some fail-safes or some things that you can do that you can default to when you run into some of these psychological barriers is imperative. You don't want to get months or years or whatever down the line and run into some of these things and not know how to address them. So this is something you want to work on a regular basis and consider in theory and prepare yourself for. Well, what if I, run into multiple losers? What if this happens or that happens or whatever it may be? Right? What are my fail-safes for that? It's not that you want to focus on the negative, but you want to prepare for it. I don't think that just focusing and being fearful is going to help. Obviously, that's one of the facets of the psychological barriers that can stop you. But you want to know that they're there so that you can prepare yourself for a plan of action in the event that those things occur for you within the market, right? Okay, so the following are a few prevalent examples of psychological barriers which, if gone unchecked, can mean margin calls for your live accounts. And for those of you guys that didn't watch the margin lesson, you definitely want to watch that. We talk about margin and free margin. So you'll understand what a margin call is. Basically, a margin call just means you got removed from the trade without hitting your stop loss or take profit, and you're probably down, the vast majority of your account. So you don't want to be margin called. But a couple of psychological barriers could be greed is one of them, right? Having a plan for take profit and stop loss, and deviating because you have a good feeling about this one, quote unquote, right? Or a bet the farm trade. There's a lot of this rhetoric that gets thrown around when it comes to day trading, right? I've got a hunch about this one. I've got a sense about it. If your sense or your hunch or, someone else's input is contrary to your trade plan, then stay away from it, at least in your live account. If you want to go into demo, definitely go into demo, have at it, right? Have a good time. And again, and I'll remind you guys of this, in any of these situations, you could very well succumb to these things, to these psychological barriers like greed, right? And the worst thing that can happen is that it works out, right? So you say, I've got a good feeling about this one, or I'm going to bet the farm on this one. I'm going to put a higher lot size. I'm going to trade more on this particular trade because I've heard good things about it, or whatever it may be, right? Or feel really good about it, and it works out for you. Because all it takes is one time for it not to work out for you to really be damaging. All right? And just to give you guys, a clear picture, let's just say, let's go here. Let's use a clean chart. And let's go from down here to up here. Okay, this is more of a longer term type trade, right? And let's say you just happen to get in at the bottom of this and then get out at the top. This is about a year, right? 295 days. So that's about a year. This is actually, if you look at a calendar year, it's over a calendar year because we're already the last day of April, and this is, the first day of March, right? But actually, so to that point, it would probably, this is, let me just tell you exactly because it's going to bug me. All right, so that's 1/7/21. So that's, just under a year, okay? So just under a year, and it moved 1,702 pips, okay? 1,702 pips. So let's say that you had this inkling to, do something that you shouldn't do, right? And you just so happened to get in right here at the bottom, and then it came all the way up here, and you got out right there. 1,700 pips later, right? So let's say you had a $10,000 account, okay? And you were trading a lot size of, I don't know, let's just say a lot size of 5.0, okay, which is $50 per pip. So 1,700 times 50, $85,000. Let's double it. Let's say you were putting in the max lot size. The max lot size you could with $10,000 account, so you're putting in a 10 lot. Okay, a 10 lot with $10,000 account, it's $100 per pip, right? So this is obviously going to be times 2, and you're looking at $170,000. Okay, $170,000. So ask yourself, is that enough to just be done? $170,000. Is that enough just to say, okay, I'm done. I'm not going to trade anymore. It took you a year to do that. Right, we have traders that do that in less than a year, obviously, with multiple trades versus just one trade. So, and not over leveraging and not running the risk that if that trade goes against you, even just a little bit, you're done for. You're kaput. There's no taking it back. You get margin called, and say this is, for example, this currency pair is Euro USD. So you're left. You have a $10,000 account. You're left with $600 in your account because you got margin called. That's it. You lost $9,400. That's the most likely scenario, is you're going to lose that, right? Because you can see from in this last year, that's the highest and the lowest that it went. And maybe you find a currency pair that does better, whatever, right? The point is that you don't really know how to replicate that. You got lucky, like hitting a jackpot in Vegas, right? And you can see that there was one instance that you could have done that, and you got that instance, but it perhaps convinced you that you figured something out. So unless you're willing to take a gamble like that, to lose everything or make a whole bunch and then quit, don't do it, right? Because it only takes one time for that not to work out, and you're done. You're out. Okay, you're out of the game. Well, obviously until you put in more money, right? You got to get some more capital and put that back in, right? Point is that it's not worth it. It's $170,000 over a year. Some of you guys are already making that at your jobs, right? Now, obviously that would have worked out better because you put in one trade and just let it sit there, and it worked out really well. Great, right? But that's not day trading, and two, it's not duplicatable. But if you do something like that, and then maybe not that extreme, but you do something similar to that and it works out for you, you become convinced that that's the way it's done, and that's not going to be the last time you do it. And because it's not going to be the last time you do it, the next time you do it could be the time that it doesn't work out and it wipes you out. I have traders right now that have traded in the financial markets and have had weeks that are six-figure weeks, right? A week where they made six figures, just trading that week. A month where they had six-figure months. 6 months where they had seven figures in 6 months. And then the market changed and they were using too much risk as it was. And just because they have more in their account meant that they just stepped up. It may have been the same amount of risk, but it's still a larger risk than they could have afforded. And it only took one or two trades to wipe them out, to give it all back. So the problem with that is that, again, you convince yourself that whatever it is that you're doing is good, right? And that you're going to continue to do that because it gave you that dopamine, it gave you that rush, that adrenaline, it gave you whatever it is that it gave you that convinced you, not logically, but emotionally, that that's the correct thing to do. And it's difficult to break those. We have traders all the time, and I tell them the one thing that we talk to with traders that have traded before is, if there is something that you have that we feel is going to be detrimental to you, matter of fact, we'll say, if you're not willing to forget everything that you know, not to say that we are absolutely going to ask you to do that, but if the time comes and we realize that we need to ask you to forget everything you know, or a few things, or whatever it may be, you have to be willing to do that. Otherwise, there's no sense in going forward with us. And we tell the prospects that up front. Before we accept you into our program, that's what we tell you. If you've traded before, listen, if you're not willing to forget everything you know and let us retrain you, this is not a good fit. Don't even bother, because we know that there are people like that happens to. And it's sad and it sucks, but the thing that is causing for them to fail is the thing that they are just absolutely married to, and they will not relinquish. And if you can't get beyond that, then there's no teaching them something new. There's no teaching them how to properly day trade. A lot of them feel like, well, I've got this piece figured out, but there's something missing, and that's why I can't be profitable with doing it this way. And you listening might be one of those people. And I'm telling you right now, it's that same thing that's probably causing for you to be a loser in the market. It's that thing that you don't want to let go of. That's what's causing for you to lose in the market. Okay? And a lot of it can be traced right back to greed. You want it now. You want the jackpot. You want to be able to get it as quickly as possible, and you don't want to have to wait. You don't have to work for it. And really, relatively speaking, we're talking about an hour a day at most for most of our traders, right? They take 1 to 2, maybe 3 trades a day, and they're done. Okay? Why? Because you've made enough in that time to supplement, replace, build wealth, whatever it may be. Supplement or replace your income, build wealth, stack your retirement, whatever your goals are, you've done it within that hour. And now you get to just go and enjoy life, go in and do whatever it is that you want to do, right? And for some of you guys, it's hard to understand. That's like not going to work unless you want to, right? Like me, I want to be here. I want to do this. I love this. This is my passion, right? I love doing this type of stuff. And so this is what I choose to do. At any given time, I can just stop and not do it anymore. But that's my choice, right? Some of you guys work at places where if asked, if you like your job, you'll spill all the, basic rhetoric that everyone else does. Oh yeah, the benefits are great and the pay is great and I love my colleagues and so on and so forth, right? And it's like, well, what do you do for a living, right? Well, I make, toilet scrubbers. I make plungers. I don't know, right? Do you really, when you were 5 years old and you were asked, what do you want to do when you grow up? Did you really raise your hand and say, I want to do whatever it is that you're doing today? If it is, great. Great. And maybe that's why you're looking at trading, is because what you want to do you're already doing, but it's not making enough to support you and your family or just you, right? So you need something else so you can continue to do what you love, which means you've beat us to the punch, right? Because I did it the other way, right? I did what I had to do and convinced myself that I love those things so that I could do it every day, right? And maybe you're already doing what you love and you want to continue to do that, but you just need the finances in order. Well, great. That's another good reason to day trade, right? But most of us, we do it the other way, right? You're at a job and you've convinced yourself that you love it. You love what you do. But ask yourself, would you do it for free? Right now, you could go into your office and say, I'm going to do this for free. Could you? Right? The answer is no, then you don't really love it. Right? I'll be honest, I don't like, making breakfast for the kids or helping them out with homework and stuff, right? I already did my time in school. I don't want to have to, repeat it with my kids. But I do it because I love them, right? And so I do those things because I love them, and I'll do the things that are difficult because I love them, right? And that's different because when you look at a job, it's like, yeah, I love my employer or I love, the people that I work with. But would you do it for free? Right? You love them that much? Right, so it kind of gives you a clear perspective. Okay, am I really doing what I'm called to do, what I would love to do, whether it's travel or work or donate your time to a charitable cause or sit on the couch and do nothing or whatever it is that you feel like you'd really want to do for the rest of your days, right? That's what you really need to consider. And if you have a vehicle that's going to get you there, is it going to be working until you're 65, 75 and hoping that you stacked up enough so that you can live your golden, 5 to 10 years in retirement without having to work? So that's it. For let's say you live to 70, so you work 65 of those 70 years to enjoy 5 of them. That doesn't make a lot of sense, right? So relatively speaking, this is a better alternative, right? That's why people look at day trading. Okay, but there's that slippery slope because when you go from wanting it and wanting to push it to give you something better, you fall into these things like greed, right, where you want to just push it even harder, right, because you want to already be there. You want to already be 1-2 years down the road. And that's what you really have to commit. And if you're not aware of that, somebody lied to you, right? You want to commit a year or two to day trading, okay? And for some people, it's much more than that. It's double, triple that amount. Right, so doing it the right way, a year or two. That's what you have to commit to doing it the right way for a year or two. Okay, and so doing that and understanding that and having clarity on that will help for you to stay away from this greed factor, especially because you don't want to be set back in that path and that process. And you can be. One trade can set you back, all the way back. How frustrating would that be if you're a year, 2 years down the road and you do something really stupid that you shouldn't have been doing, right? And you're now set back, even half of that amount, right? You're almost there. You're close to just walking away from your job, or you've already supplemented your income, or whatever it might have been, right? And now you're set back from that point because of one greedy, silly move that you shouldn't have been doing to begin with. So just slow grow it. Take your time with it. And again, it's relative. Slow grow is that's relative term. Right? Compared to anything else, this is booming. You look at we clack our heels, we'll make 18% on a 401k or a Roth in a year. Right? We've got people that are doing 18% in a week without breaking a sweat, right? Some in just a couple of days. So it's relatively speaking, it's slow, but don't rush it. Just take your time with it. Fear is another big one. Taking a few losers in a row has caused you to second guess your strategy, and now you're too fearful to pull the trigger or remain in a trade until it either hits take profit or stop loss. Right? So calling those audibles when you're in a trade because maybe you've had some losers or maybe you're even on a winning streak, right? And now you're fearful that you're going to snap that winning streak or whatever it may be, right? Or maybe you're doing something you shouldn't be doing, right? Don't over leverage yourself. Don't put in a trade that you shouldn't be putting in. Don't do something that's contrary to your rules, right? To whatever your trade plan is. If you've back tested, I've got a 10 pip stop loss and a 10 pip take profit on this currency pair at these times with this setup. I have back tested it. I know that it's going to work out 75% of the time. I'm just going to push that button every time it sets up during the times that I back tested it for religiously. And that's it, right? And then you deviate a little bit from that, and then that fear starts to kick in. It starts to kick in and take over. Right? You start doing things that are illogical, and they're emotional. They're not based on your logical strategy, right? They're based wholeheartedly on emotion and fear, right? Because now you're afraid that it's not going to work out, or perhaps a trade gets really close to your stop loss, right? You've got a 10 pip stop loss and it's gone 9 pips already. Now you're certain that trade is going to lose. Well, first of all, it doesn't matter. The best thing for you to do is just walk away, because I'll tell you right now, if you've back tested, okay, the analogy or the example we're just using, 10 pip stop loss, 10 pip take profit 75% of the time. So 15% of the time you're going to lose. And you're about to lose that trade, and it hits your stop loss, and you've lost that trade. That is a successful trade. You didn't hear me incorrectly. You traded that successfully because you successfully executed your plan without deviating. Losing a trade is not a failure if you've already planned for it. You don't know when the losers are coming. You don't know if it's going to be the next trade or the following, so there's no sense in worrying about that. Once you've done the homework, once you've back tested, you understand how that trade is going to play out in the market, you just execute according to plan. That's it. And when the losers come, good. All right, I was expecting you, right? And looking at the data that you collect and understanding that you're going to have back-to-back losers like we were looking at last week, right? The probability of back-to-back losers and back-to-back winners, okay? They're going to be there. And knowing that they're going to be there and how often they might be there is helpful in the psychological, facets of trading. Because when they happen, you're not caught off guard, or you're not, maybe somewhere in the back of your mind you expected that they were going to come, but now that they're here, you're having to deal with them, right? Just know that when they present themselves, you understand, you acknowledge, okay, here it is. Of course, I knew at some point it was going to come. It sucks when it happens early, right? But better to get it out of the way and just continue to stay the course, all right? And the hardest thing to do sometimes is take losers, and then when your setup comes available, press that button again. Push that button. Get into that trade. It's the hardest thing to do sometimes. Force yourself to do it. This is how I win, right? I've got to push that button, right? You've got to do it. You've got to stick to your plan, especially when that fear takes over. A really good way to circumvent some of these things is to have a trading partner, okay? Closet traders are the most psychological messes you've ever seen. And a closet trader is somebody that maybe their friends don't know that they trade, or their friends do know that they trade, and they maybe make fun of them for it, or people just write them off. And, I had a friend that always told me, you're trading, that sounds cool, it sounds interesting, let me know how it goes, right? And then I had a big, benchmark. I doubled my account. And I'm talking to him again. This is a good friend of mine. I saw him on a regular basis. And I wanted to talk about my cool new toy, right? And so, we'd start talking about it. And, I tell him, I doubled my account. He's like, oh, that's great. Yeah, let me know how it goes, right? Oh, well, I made, 6 figures. Oh man, that's awesome. That's great for you. Yeah, let me know how it goes. And well, I made seven figures, right? And oh, that's incredible. Wow, let me know how that goes. I'm kind of like, I already have let you know how it went, right? And later, he came to admit that he kind of kicked himself in the tail for not jumping in on it, and started trading when I did, right? Um, and so fortunately, I had other people that I traded with, like my business partner Tim Kovlin, and other people that are part of our trade circle. But there are some that don't have anyone. They don't know anyone except for maybe people on forums, and they're just all by themselves. And they're called closet traders. And when they get into situations where those emotions start to overcome them, they succumb to them, right? More easily than someone who has someone else to bounce ideas and concepts off of, or to hold accountable and keep accountable to, right? So when greed or fear or boredom or any of those things start to kick in, that person can help pull them out of that funk, right? You've got some, outlandish plan that you want to try out in the live market without testing it or anything. If you've got somebody that's looking over your shoulder like, why the heck did you take that? That's not part of the trade plan. It becomes more difficult, or explaining why you have that loser to that person, right? Or them having to explain it to you if you're their accountability partner, right? So we're big on trade circles. We always, in our organization, we have multiple ways for traders to communicate. Different chats, different chat groups, webinars that we do live with our members, 3 times a day. 7 days a week we have at least one webinar, at least. There's one on Saturday and one on Sunday. With the exception of Saturday and Sunday, it's 2 or 3 a day, right? Throughout the day, morning, afternoon, and evening. We're taking trades with our members. We're doing additional education. We've got symposiums that we do once a month on top of that, where they're bigger events where, we've got people from all around that attend those as well. So we've always got a way for traders to plug in to be able to, interact, because these webinars are interactive. You can chat and you can, converse with the coach or the person that's hosting that webinar. But in addition to that, we've got different chat, applications and things that you can have even on your phone or on your desktop that you can chat, with other coaches or with other traders. We meet live in various parts of the country where traders can go to a live setting, and it's become harder, obviously, with COVID, but prior to that, we were meeting live in various places, and people would come out and congregate and socialize and connect with other traders, right? But the most effective is when you've got someone that you already know, a family member, a friend, somebody that you have barbecues with on Sunday, whatever it might be, somebody you see on a regular basis. Those people make the best trade partners, because those are the ones that know you best, and you trust enough, and they trust you enough to hold each other accountable. And some of the most dynamic duos that we see are husband and wife. It brings to mind, and because I was just speaking to him the other day, our friend Corey and Joni. They're awesome, and they're opposite ends of the spectrum. Corey is much more aggressive in his trading, and he likes to take a lot of trades, where Joni is much more conservative, and they both do really well, but they hold each other accountable, and they're there for each other when some of these things may rear up, like greed or fear or whatever it may be, right? So people that like a spouse or a friend or family member, are always going to be the best when looking to have somebody as a trade partner, building a trade circle. And the more the better, right? 2 heads are better than 1, 3 heads are better than 2, so on and so forth. Boredom is another one. We kind of touched on this a little bit. Perhaps you've made a plan to take a certain amount of profit for each day, and you find yourself reaching that goal rather quickly, or you have you set around multiple days in a row waiting for your setup to have set up, and have yet to see what is necessary to execute your trade. Right, so there's a couple ways this can happen. You're sitting there and you're waiting for your trade, and some of you guys, maybe you're more impatient, and maybe it's taken too long, or you're the time that you've allocated to trade is almost up, or it's just you haven't had enough sleep, or perhaps you've got something planned after that. I think some of us that have been trading for a while, and we. Like for a while I didn't do anything else but trade, and then thought, I'd be okay staying at home. And that didn't work out very well for me. I went nuts, so I didn't ever do that again. But we seem to have these same proclivities where it's like, okay, well, when I'm done here, I'm gonna go, fishing, or I'm gonna go to the movies with the kids, or maybe, there would be times where I'd be out of town, right? And I'd get up for, to put in my trades. And sometimes after a while, I just didn't trade when I was on vacation. But, there was a time where I was really serious about, I've got a goal and I want to meet that goal. And so even though I was enjoying the fruits of my labor, I still wanted to stay very strict on meeting that goal. And that meant trading every day. And so, we'd have big plans for that day, right? We'd be out of town with friends or whatever. And it's like, okay, well, once I'm done with this, then, I get to go and do all the fun stuff that I'm going to do. And so then it becomes less important. You get bored with it, right? And sometimes that'll kill you, because either you're not paying attention, you start doing things that you start making habits of doing things that distract you from focusing on trading, right? You're surfing Facebook, or you're playing a game, an app on your phone, or watching YouTube, or whatever it might be, right? So, or even texting or calling somebody, and it takes your focus away from trading, even though that's what you've allocated to do for that time slot, whether it's half an hour, or whatever. That's the time that you've allocated for trading, and that's what you need to focus on when that time is there, is just trading. It's time to put on your work hat and do just that thing. It's just an hour, right? It's just a half an hour, whatever it is that you've allocated. Or sometimes you would take a trade and you're all excited about it, and you win, and now you want to win. Now you want to get into it again because you felt excited about that winner, right? You followed your plan, everything worked just fine, and you won, but it happened within seconds. And you're just kind of sitting there like, well, I kind of want to do another one, right? Because that was fun, right? So now I've come off of that high, and it's waning, and I want to get that dopamine effect again, right? I want to feel that rush again, right? And you start to force things. You start to get into a trade. Maybe the trade's set up, and you have it back tested for 10 pips, like we were saying, and it took that 10 pips, but then it came back, the other direction, and now you feel like, well, I'm bored. Maybe I can just take it for another 10 pips, in the same direction. No, you've already executed that plan. It's already been executed. It's already done. Move on, right? Go and do, wait for another setup, or walk away, whatever it might be, right? But, there are a lot of things that can cause that boredom. Right? You're just kind of sitting there watching the paint dry because you're waiting for your setup to happen. So, be aware that those are some of the things that you can run into. So what are your fail-safes for those things? Right? For me, it was like, okay, well, I'm just going to back test if I'm waiting for a setup, and perhaps I'm going to be waiting 30 minutes, or let's say that you've back tested a setup that you're only going to take at the top of the hour. Well, then you're not going to focus, and you've got maybe a 2-hour block that you're trading, right? So I've made it a goal to trade between 7 p.m. or 7 a.m. and 9 a.m., right? Let's say that, for example. And so you're there at 7 a.m., but your setup's not there, so you have to wait until 8 a.m. Well, what I did so I could stay engaged in trading in my education, always sharpening my axe, was I just started to backtest while I was waiting for that top of the hour, while I was waiting for that setup. If I was waiting for positioning and I thought it was going to be a while, then I would have, it kind of there, and then, if it were a 5-minute, positioning, then every 5 minutes I'm checking in on it, right? But that's my focus. What I would be doing in backtest would be secondary. But, after a while, you backtest enough, and it's like second nature. You can do it and other things, like as if you were peeling a potato and having a conversation, right? You can do both simultaneously. And so there are things that you can do, again, to help circumvent some of those things we talked about. Greed, fear, boredom, having a trade circle to help circumvent some of those things, with greed, knowing, okay, reminding yourself that you don't want to make those bad habits, that there's not a payoff enough that's going to justify doing something ridiculous that could cost your whole account, understanding what the consequences of that would be, but not to the extent that it pushes you into fear, right? But knowing that, in the fear aspect, and with all these for that matter, knowing that you've got a trade plan and you stick to that trade plan, and that's how you're successful, right? and eventually you're going to become callous to the losers, and eventually you're going to become a callous to the greed factor, hopefully, right? Boredom, that one is a little more difficult because I feel like it becomes more prevalent the more seasoned you become as a day trader. Okay, so know your limits. In the past, we've discussed using the correct lot size, right? Matter of fact, we just talked about that last week, based on your proper risk. This calculation is derived from a combination of your win percentage, risk, reward, and probability, right? We talked about that. What we have found, however, is that for many, there is a threshold wherein traders will find themselves uncomfortable with the level of risk. So although it's not recommended that a trader should use an arbitrary lot size like a 0.01 like we were talking about last week, don't just use some arbitrary number just because it's the lowest or because it's a round number or whatever. It would be wise to determine the percentage of your account that is better suited to your risk appetite. So if the trade calls for a 1% risk, but you feel like that would be unnerving to you, then back it off, right? Maybe do 0.75% or 0.5%. Back it off until you feel like, okay, I can deal with that. I can, psychologically, I can deal with that. Because I know some of you guys, we've had traders that will not only trade our money, but also have, a $100,000 account that they're trading, that they've funded with their own personal money. And so, putting in a 1% risk on a, $100,000 account and just going into the market, being brand new at live trading, that could be unnerving, right? So, it's $1,000 that you're risking right there in one trade, right? So, maybe backing that off by a percentage, not by a lot size. Your lot size is determined by your risk percentage. Okay, not just by some arbitrary number that you pulled out of the sky. Okay, so you always want to base it on a percentage of your account. Otherwise, you're going to miss out on growth. But that's one of those ways to help circumvent some of those things like fear. Obviously, that wouldn't be an issue for somebody that's dealing with greed because you're going to want to jack that up, higher than you would than you should. But for those that maybe deal with fear or some of the other facets. Know that you can deviate from that if it's decided to begin with, that you're going to decrease that risk percentage, but you're not going to default to just some arbitrary lot size. Okay, I can always tell. There's a number of things that I'll ask traders to know if they're actual traders or not. One of them is what lot size they use. Right? And the correct answer is not, I use a 0.1 lot or 2 or a 10 lot or whatever. The correct answer is, I risk X amount of my account. Okay, that checks off for me. Okay, you at least know that. So there are other questions that I'll ask them, but that's a dead giveaway. A dead giveaway that you're not a professional day trader. You're not making money in the market if you're just using the same lot size for everything. Right? There are exceptions to that, like if you're trading the futures market, and you have yet to break the amount that you need in that account in order to increase your contracts. So there are some exceptions to that, but when we're talking about Forex, that's the dead giveaway. Okay. So strengths and weaknesses, a major component in trading successfully long-term is adequately identifying your strengths and weaknesses. For example, if your personality is such that you find yourself anxious, waiting too long for a trade to complete, it is likely that a long-term approach is not fitting. Where on the other hand, if fast-moving markets are stressful, perhaps trading at times where volatility is lower would be more suitable. At this point, hopefully most of you, if not, then you will eventually. But some of you have had experience in both scenarios, hopefully in just demo accounts thus far. Unless you're beyond that and now you're trading with live money. Although I would recommend always testing the limits of your comfortability, it is always wise to do so in demo first. So and we've talked about this on other occasions as well. There are some traders that they become anxious when the market is moving too fast, and there are others that become anxious when the market's moving too slow, right? And so understanding which one is best for you is going to help you determine when you should trade. No one knows the answer to that but you. You can Google right now, or you can go onto forums right now and you can ask or you can Google and find out what are the best times to trade. Those answers are not your answer, okay? Those answers are based on their bias. because they believe that you need movement, you need volatility, you need volume and liquidity to make money in the market. That's not true. That's not true. It may be true for some because of the stuff that they're using to trade with, right? So they have to trade during those certain times. But there's others like us, and we don't have to. We just trade whenever we want because our indicators work very effectively, and we know how to show ourselves how they're going to work for us for the specific times that we trade, right? So part of it is determining when you're available to trade, right? Because you don't want to say that you're going to trade in the afternoon if you're always at work in the afternoon. Or you're not going to say in the morning if you're getting ready for work. Or you're not going to say in the evening during dinner time or after you'd be asleep at midnight or 1 or 2 a.m., right? You want to pick a time where you are going to be available to trade, whether it's in your lunch break or earlier in the morning or in the evening after you've settled in, if you've gotten home or whatever. Right, after your commute, after you've said hello to the kids or the husband or the wife or whatever, right? After all that stuff is done and you've got that moment where perhaps you're turning on Netflix, that's probably the time. The time where you normally watch Netflix, that's probably the time right there, right? Because you can blow 5-6 hours watching, believe me, I know. 5-6 hours watching Netflix, right? You're like, holy cow, where did the time go? I got to get up in the morning, right? So that's probably the time that I can do this time every day. That's the time for you. Within that time, you can decide, do I like a fast-moving market or a slow-moving market? And then based on that answer, you can say, okay, in that case, I am going to trade in this currency pair, right? This is why we start with Forex, guys, because it gives you the ability to circumvent a lot of the psychological facets of day trading while trading in the Forex market because there's more leadway as to when you can trade, and it's more adaptable to you, your risk appetite, and your personality, and your availability, right? It becomes very personalized. And then once you get past a lot of those psychological facets or you become callous to some of these things, then it's easy to transition you or for you to transition yourself into other markets, okay? So there's a lot of reason why we've built our program the way we have. It takes into account every facet of day trading. We don't leave out anything. Every single facet of day trading has been covered, and we have not only solutions but redundancies to those solutions so that it fits with who you are, right? Because it allows for us to tailor an approach that is going to be correct for you as an individual, not a cookie cutter approach that's supposed to just fit the general populace, right? So within that time, then we can help you figure out which currency pairs would be moving or not moving at that time, depending on what your risk appetite is like and what your personality is like. And then develop a trade strategy, and we've got our pick. We've got a ton, different patterns, different strategies, tons of stuff, right? And new ones are coming up every day because we got students that are just going off and making up their own, right, with our indicators. And they're very successful with them, and they're so much so that they're able to teach other people how to do it, right? It's duplicatable, okay? Like we've got patterns, we've got tons of patterns that are everything from beginner to novice to advanced, people that have been around for a decade or more, right? That can wrap their minds around. So some of you may be making the transition from systematic trading to a more discretionary approach, right? Systematic is like square peg, square hole, right? Like a pattern. This is the pattern. When you see this pattern, this is what you do, right? Based on your backtesting. Discretionary is more like just reading the indicators and understanding what they're saying, and then be able to place the trade based on your read of the indicators. Now, it's not that a systematic approach is not reading the indicators, but it's using more, like sight words, right? Like when we first learned to read. So let's say, for example, this duckbill. So this is a systematic approach. So we're saying, and I'll show you guys this really quickly, because I like to at least show you guys one setup during these sessions. But a duckbill is really simple. This is on a one-day chart. We just want what we call a hiccup to occur on the previous day. Okay? So let's say this is the blue line, the overbought right here. And then this is the oversold, right? So we want this hiccup right here. The green line came up and is pointing down now above the blue, and then the red line is up and pointing up. We call it a hiccup because the lines within the pair are disagreeing. Minors can do this too, but we're looking at the majors. Just the majors, just the green and red lines right here, right? So this is called a hiccup, and that's all we want to see happen on the previous day above the blue line, or upside down below the red line, right? So it would be like this: green up, and then red down. So you can see the green is pointed down, red is up. Here the green is up and the red is down. So in this example, we can see that the green is down and the red is up. They're in different directions. And if you guys watch the video on hiccup pattern, right, where we look at it on the 60-minute, which is kind of what's happening right here, a hiccup pattern, you guys understand what that means, like what's happening there. If not, I'll likely touch on a different session. In any event, we want to see that happen above the blue in this case because it's overbought. And then on the next day, on the next candle, right, we want to see that the green has then gone from pointing down to now pointing up, right, and the red just continuing to point up, right? And if I draw a little eyeball right there, it just looks like a duck, and this is the duck's bill. So it's cheeky, but that's what we call it, duck bill. All right? So this is what we call an illogical setup, because right here what we're expecting to happen is a short or a sell, right? So this is a pattern, systematic. You look for those parameters, right? We send out alerts for them. We send out trade alerts for them that just tell you when they're there, right? With ample notice so that you can get into that trade. Then all you do is verify it. And then, you know, you could use like a one-to-one. We find that these, and I can actually give you parameters for this because these are easy to backtest because they're on a one-day chart. And, of course, everyone's going to trade a one-day at the same time at the end of the day for this systematic setup, right? So the time of day is going to be the same for everyone because it's UTC time, 5 o'clock Eastern, so it's always going to be the same for everyone, right? And you might be able to backtest and find, you know, some of our students will backtest and use positioning to get more or trail to get more, but let's just start with something simple like a 50 pip stop loss, which, by the way, with positioning, you can really bring that down to like 20 pips. But we'll just say for someone that just barely found out about this, a one-to-one, 50 pip stop loss and a 50 pip take profit. That would be ideal, okay? And you can win that like 70% of the time, and that's not an exaggeration. And I can show you data on that, which is why I can tell you that. Otherwise, I wouldn't be able to tell you that. But it happens at the same time every day, right, which is 3 o'clock my time, 5 o'clock Eastern, on a one-day chart, and the one-day chart always ends at 5 o'clock Eastern, right? It's very specific parameters, back-tested for multiple years, 5 years. You know, we can see that a 50 and 50 works really effectively. Okay, so this would be for a sell, which we call illogical, again, because these are pointed up. But it's not the direction that they're pointed, it's how we're reading it. And what it's telling us is get ready to sell. And sometimes get ready means position, so wait for it may go up a little bit more if we use a shorter time frame to see where that may go. And then execute. But again, if you were just getting started and didn't really know much about it, you could take this and just enter, you know, right there, and you're going to win, you know, 70+% of the time. But just so you know, even if you hit 60% on this, right, a whole 10% difference, you would still be profitable with a one-to-one risk to reward ratio if you took these every time they happened. So you'd be looking for a short, and that one moved down 100.6. So you can see how some of our traders can trail that and get more of that position, because you can see it drew down about 27.1 pips. So you could have positioned and taken more, or positioned and saved yourself the drawdown, so on and so forth and so on. Anyhow, so that is a systematic setup, right? That's a pattern. It's a square peg, square hole, where someone looking at the indicators more discretionarily, let's say this wasn't a duck bill, and let's just say this is more like a, you know, overbought, double confirmation, maxed out on other indicators. Just looking at other indications, we could say, okay, you know, this is going to be, you know, a short trade, right? But not really relying on a pattern to tell us that, but just understanding the nuances of all of these lines. That's discretionary trading. is understanding how to read these more fluently, understanding the nuances, not necessarily having to wait for a pattern or a systematic trade to set up. And then there's a hybrid approach. And the hybrid approach is kind of like, one example would be, okay, here's the duckbill, but I know that if I use a 60-minute or 240-minute chart, I can position that, so I'm going to wait for my entry on a smaller time frame. Or, when I see this duckbill and pressure looks a certain way, based on some of those nuances, I'm not going to take that duckbill. And a lot of times those people will have obviously higher win percentages than just the standard systematic folks will. Nonetheless, both of them would be profitable. Obviously, one would be a little more profitable than the other, and again, that's based on their discretionary systematic hybrid, right? So they're using kind of both to determine the best place and when and how to enter a particular trade setup, which I would definitely recommend. Systematic or hybrid approach is the best in my opinion. So if you're making the transition from systematic trading to more discretionary approach, be mindful of what you feel when entering a trade based on discretion. If you find that you're feeling out of place, perhaps more practice is necessary before you can fully trust your judgment. Whereas if you find that a systematic approach is best for you, understand that there may be situations where you aren't entirely comfortable with the way the setup is formed, right? So maybe you're only comfortable with a systematic approach, but in that systematic approach, you've seen it so many times that now you're starting to notice things, some of those nuances, and you notice that when those nuances occur, you have less than desirable results, or maybe you have better results than you expected, right, if some of those other parameters are present. So here's how you circumvent, for one, doing nothing or freaking out, and making an irrational decision or whatever it may be. You test that theory, right? Let's say with the duckbill, like we were just looking at. Let's look for another example here. So here's one. So let's say that, and we can see right here. So this is not one because it happened in the channel. That's why I marked that one, but we're not going to talk about that one. Let's talk about this one because this one is one. See, that has a dotted line. So I said, I just wanted to show you, but I'm not going to take the time to show you that right now. Right here we can see that the hiccup, right, like we talked about, that first thing, green down, red up, happened above the blue in this case again. And then green pointed up and red pointed up, and that created the duckbill, right? There's the eyeball, there's the duck, okay? So let's say that we just found that, when pressure looks a certain way, maybe we get more drawdown, or maybe we could take more profit, right? Well, then instead of just jumping in and doing that every time we see that parameter present, pressure looks a certain way, we test it. We go back on our back testing data and we say, okay, if we would implement this, would this make us more profitable, less profitable, or would it not matter? If it makes you less profitable, obviously you don't use it. If it doesn't matter, then you don't use it. The only time you would use it if it makes you more profitable. Now, why we wouldn't use it if it doesn't matter? Because all it does is complicate your setup, right? We want to use the KISS method. Keep it simple, right? Stupid. Or keep it simple, straightforward, right? However you want to put it. But let's just keep it simple, right? Or you can say keep it stupid simple, right? So by backtesting and collecting that information, then we're taking a scientific and mathematical approach to something that could very well benefit us. But instead of just taking some, whim and perception, right? Because our perception is going to be based on what our brains pick up most often, and that's usually the negative, right? Oh, well, this, pressure looked that way that I've been, contemplating, and the trade would have done better than I expected, or I took the trade and pressure didn't look that way and it lost, right? Those are the things that you pick up on. Those are the ones that you're going to remember, even though they may be the exception and not the rule. But it's going to stick out in your brain so much so that you're going to think that's what always happens. Every time I see pressure look like this, the setup works more effectively or doesn't work very effectively or whatever your perception is, right? That's all it is at that point is perception. It means nothing. So you've got to go and test that theory to see how relevant it is, if it's going to help you or hurt you or be insignificant. All right, and only one of those means you're going to institute it, is if it helps you, if it makes you more profitable, right? And it may make you more profitable, but decrease the frequency to such that you're not able to take the trade as often, which in the long run would make you less profitable. So those are the things you want to consider as well. And later, at another time, we'll talk about how to look at the data in that way. But that would all obviously include looking at backtesting the correct way, which, well, I've showed you guys a way, but the most effective way of backtesting, the absolute best way of backtesting. Haven't showed you guys that yet. So if you find that if you find that a systematic approach is best for you, understand that there may be situations where you aren't entirely comfortable with the way the setup is formed, right? So again, you take something that you may be noticing and you test it. You don't just implement it. So in the meantime, your setup is present, you plan for it, stick to your plan, right? Otherwise, that fear starts to kick in, right? And every time you see that parameter, it's going to make you fearful that either you're not taking enough or you're taking a trade when you shouldn't. Usually that's the case. You're taking a trade when you think you're going to lose, and maybe you hesitate to take the trade, right? But when you see those things, test them so that you can clear it from your mind. Then you understand it. Then you know scientifically, mathematically, yes, this is good, or no, it's not good, right? And then you can check it off your brain, and then you don't fall victim to fear. Okay, so again, you've got to have these fail-safes, these things that you can default to, so that when you run into some of these psychological barriers, you know how to overcome them effectively, efficiently, right, and become callous to them. Because the more you overcome, the more it gives you that confidence that, you know what, put it in front of me, I know how to deal with it. I can do it, I can deal with it, I can handle it. And then there's no stopping you, sky's the limit. Okay. So be aware of these symptoms. Here's a couple of symptoms of some of those barriers, right? Analysis paralysis. This one's huge. Sometimes issues like fear or greed will lead us to believe that more analysis, more indicators, and or more research will increase our likelihood of making successful trades. Although it is always a good idea to backtest new findings, like we just talked about, the simpler you keep your strategy, the better. Okay? So you become fearful, or you get greedy, you want to make more out of that trade, or you're fearful that you're taking trades that because certain things look a certain way that are going to fail, right? And so then you get into this analysis paralysis where you just think that if I just stare at it more often, or I try to add more to the setup, or I try to research it more, then I'll be more successful at it, right? And then you end up with just a mess. You end up with something completely different than you first started off with. So again, what did we say? We said when we identify something, we are going to still execute that trade. We're going to overcome our fear. We're still going to push that button and execute that trade. But what we're going to do in the background is we're going to test that theory, right? When pressure looks that certain way, it doesn't seem to work out as well, or it works out even better than I thought. Okay, whatever it might be, right? Whatever the perception is. Okay, you don't have any proof yet. Therefore, every single time that setup occurs, regardless of whether that newfound parameter is there, and until you've had an opportunity to test it, you're going to continue to place that trade because that's your plan. You're not going to deviate from that. You're going to continue to place that trade. And then you're going to collect that information. But what that's going to do is it's going to give you a sense of urgency to go and get that information collected. Right? So you can see, okay, do I need to do something about this? Right now, as I tested it, no, I don't. Because I tested this, and these situations were included in that finding, and so I'm going to continue to trade based on how I first saw this setup. But now that I understand something differently, I'm using some discretion, I want to see if it's relevant. So then I test it, but in the meantime, when I see my setup, hell or high water, regardless of whether that new parameter is there or not, I'm going to execute the trade, okay? And that's how you stay away from some of this analysis paralysis, because then you're only analyzing the things that you start to notice as prevalent, right? Or they may appear as prevalent. But you're not staying stuck there and just trying to overanalyze and continuing to analyze. You may continue to, find other parameters and do more analysis, but again, what's going to come out? Either yes, it's more profitable, no, it's not profitable, or it's moot. It makes no difference, right? So 1 out of 3 that it's going to work, and you're going to use it. 2 out of 3 that you're not going to use it. But now okay, I'm not going to use it. I'm not going to focus on it anymore. It doesn't matter because it's not useful. It's not more profitable. It's going to happen, and I'm probably going to notice it from here on, but I'm going to do nothing about it. I'm not going to deviate from my plan. I'm not going to add to my strategy because it's either less profitable or it doesn't make a difference. Right? Another is revenge trading. Okay? So perhaps you had a situation where you thought everything was perfect for your setup to succeed. You place the trade and it loses. Suddenly you feel abused in some way and convince yourself that although the trade hits stop loss, it will still turn the other direction. Or you've taken a few losers back to back, and now you're on a tirade to show up the market and get your money back. You deviate from your trade plan and start placing trades on a whim or increasing your lot size outside of what your trade plan recommends in an attempt to recoup your loss. Don't do that. A loser's a loser. Again, if it followed your trade plan, then it was a successful trade. Even if it lost, that's part of the plan. We know it's going to happen. We planned for the losers. We don't know when they're going to happen, but we know they are going to happen, and we planned for them. So that lost. Okay, I planned for that at every juncture. I back-tested. I know my win percentage. I set my stop loss right there so it stopped me and no further than that, and I set my risk percentage to account for that. And what's best in those situations is just to stop focusing on it, okay? Because what will kill you sometimes is it just hits your stop loss and then immediately returns the other direction and would have otherwise taken profit, right? And you see that and you're like, man, if I would have just moved my stop loss out a little bit, if I would have deviated from my plan just a little bit, then I would have won that trade. Well, big deal. You would have won that trade, but you lost the war. Right? You lost the war because that is a perception. Our brains pick up on those things. I would have won that. Of course, it's a negative, so your brain picked up on the fact that if you would have done something just a little different, you would have won that trade. So now you start thinking, well, maybe I got to move out my stop loss a little more. Or maybe next time the market looks that way, I've got to just do something different so that I could possibly win that trade instead of lose it. For what? One trade? You throw away your whole trade plan, all that work that you've done, all that time, effort, energy, blood, sweat, and tears that you put into building that trade plan so that you can change your financial trajectory just to change it on a whim, to save a loser or a few losers, to potentially cost you everything. And that's that slow, slippery slope that we walk sometimes. And just those minor changes and minor deviations from our trade plan without any solid, concrete evidence that that's what we should do. And then a month goes down the road and we find ourselves in completely new territory. And we realize that we're not doing anything as it pertains to our trade plan because we've thrown so many audibles in there. We've thrown so many different, perceptionist, whatever it may be, right? We just we threw it all in there, and now it's just this hodgepodge that looks nothing like our initial trade plan, nor is it more profitable. And we sit there, we cross our arms and we pout and we say, well, this just doesn't work. Well, no, it was working great until you screwed it up, right? And it's important to take notes after each day. And we'll cover a trade next week. We'll cover a trading checklist where I would recommend you guys journal, right? Every day. It doesn't take much. It's a pain in the neck. I hated doing it, I'll be honest. But it's so awesome to be able to go back and say, man, this is where I was in these situations, and this is what I was feeling in these days, and this is what happened as a result. And I've come a long way. You can see your progress, but you can also go back and reflect on them. Or maybe ideas that you had that maybe you didn't follow up with, then you can follow up with. And it just helps to understand the psychological facets that you were in at those times, and maybe even remind yourself of some of the things that you were dealing with, what you were thinking. I put stuff in there like, oh yeah, I had a little spat with the kids because they left their Legos out, or I was late to the office today, or me and the wife had a little spat, or I woke up with a headache, or whatever it was, right? I would put that in there just see if it had any bearing. And what I was thinking when I took the setup and how I was feeling, all those things, I'd put that stuff down, and it wasn't very long. It was maybe a paragraph, right? It took me maybe 10 minutes to collect those thoughts and put them down, 10 minutes or less, right? But it was really useful. So I would definitely, and we'll talk more about that, but it helps with the psychological facets of day trading as well. So keep that in mind. So revenge trading, again, it's one of those things where it's like we take a loser, or we we had a number of losers, or that situation where it just took your stop loss and then it went back and took profit. So now you feel like, okay, I'm going to get back at the market the next trade, or I'm going to put in a trade and it's going to have a higher lot size. Or this is not part of my trade plan, but I'm just going to go on a hunch because I think it's going to continue in that direction, and I don't really have any foundation for why I think that, but I'm just going for it, right? Because now you're just wanting to get back at this thing that you somehow feel personally offended you, right? It's just the way it is. And again, having a trade plan and understanding that those losers are going to happen, and when they happen, it's successful. It's a successful trade because you plan for them, is imperative. It's key, especially in those situations where you feel like you want to get back at the market. You want a revenge trade. You want to make up for that loss. That loss is gone. Don't try to make up for it. That deviates from your plan, right? Stick to your trade plan. And believe me, it gets difficult when you've had 3, 4, 5 back-to-back losers, but you've got to stick to your trade plan. All right, guys, so I hope some of this will resonate with you guys. And for those of you guys that have never experienced some of these things, that as you transition into live trading, or if you're currently live trading and you've experienced some of these and you didn't really realize that sometimes just putting a name to it or hearing somebody else talk about it lets you know that you're not the only one. We all deal with these things. It's not like you're some kind of outcast and what you've been dealing with in day trading as far as psychology goes, you're just all by yourself, because we all have dealt with these things. There's not much in here that I haven't dealt with. Matter of fact, I don't think we talked about anything in here that I didn't deal with and I didn't do. There is nothing you guys can. I already did it all. There's nothing you guys can do that I haven't already done. All the wrong things to do, all of it. I've done all the wrong things to do in day trading. Believe me. Early on, man, I had to learn 2 or 3 times before I figured things out. And later, maybe I'll share with you guys some stories about my growth as a professional day trader. But I'll tell you, never feel ashamed or embarrassed about some of the things that you might do. Just know that they're common, they happen, and not to do them again. When you realize what they are, when you realize that they're happening to you, or you're in the middle of that thing, that there are ways that things that you can do and ways to break out of that cycle, right? That thing that just causes for you to bleed out. And become successful at professional day trading as a professional day trader, right? So hopefully this is helpful for you guys. Next week we'll talk about trading checklist. And thank you for joining us, and happy trading.